Chapter. We're talking real money.
Welcome to a Friday. It's question and answer day again. Hey, everybody. Don McDonald here. Been a crazy period here. Doing a lot of traveling. Was visiting my daughter in New York for her graduation from NYU grad school. Very proud of her. And glad you're there. You guys keep calling in questions. Calling in. Yeah, okay, I guess we're going to go with calling in. You guys keep sending in questions at talkingrealmoney.com on that contact us form, and I appreciate all of those. Remember, you can also call us on Saturdays at 855-935-TALK, 855-935-8255. It's really easy. Call Saturday, 3 p.m. Eastern Time, noon Pacific Time. But we've got a lot of questions for today, so let's do the first one.
My husband's 61. I am 54. And we are wondering, should we transfer money from our traditional IRA to a Roth IRA?
Well, this is one of those questions to which the answer is, it depends. What does it depend on? Well, it depends on what you think the future tax situation is going to look like. Are you going to be paying taxes at a potentially higher rate in the future because you've saved so well and you have so much money? Or are you likely to be paying them at a lower rate in the future? If you think you're likely to be paying them at a lower rate in the future, then no, I would not transfer to a Roth. If you have some money in a Roth, great. If you have money in both, that's the best answer because we don't know the right answer because we don't know the future. And the other qualifier on all of this is the absolute ability to pay the taxes out of other assets. If you do not have other assets from which to pay those taxes, then you should not make that conversion from a regular IRA or 401k into a Roth. You just shouldn't do it. It makes no sense. So it's a maybe, maybe not. Is it a crucial issue? I don't think so. I think we as investors spend way too much time worrying about the taxes and not enough time worrying about the quality of our portfolios. We do a haphazard, half-ass job in most cases, if even half, probably quarter-ass job, managing our portfolios because we just buy things. We buy things because we think they're the right things. We buy them because they think they're hot or whatever somebody tells us to. But no, I don't think it's a crucial question, and I know it's one that defies an absolute answer. Having both is a pretty good compromise. Thanks for your question. I really appreciate it. And let's grab another.
Hey, Don and Tom. Thanks for answering my question a couple of weeks ago. This is Casey in Albuquerque. Federal employee, TSP. I have about a little over 100,000 in my TSP, 80% C fund, 20% I fund. I tried to increase that a little bit. But I wanted to ask a specific question about the G Fund. I think that's one that you guys mentioned that you really like, that only federal employees can take advantage of. And I wanted you to kind of go into a little more detail about what you like so much about the G Fund and the TSP. Thanks for your help. Okay.
And thank you for keeping the rhythm for this question. Perfect rhythm. Was that a metronome or a clock? Probably a clock. We like the G Fund for the bond portion of your portfolio. But if you don't have nor need a bond portion, then why have it? If you're an aggressive investor with lots and lots and lots of time until you retire, then having the G Fund might not be the best thing. Having a little in it, probably a good thing. What the G Fund does is very effectively reduce volatility at an incredibly low level of risk. As a matter of fact, they pretty much eliminate volatility from the portfolio, which makes it better than bonds, better than CDs, really, because of the flexibility of the portfolio. It's special government bonds without the bouncing around, without the price fluctuation. And the yield is comparable with Treasury securities. So it's a good yield. It's a good portfolio. It's a good place to park for the sole purpose of reducing portfolio volatility. That's why you have bonds in your portfolio. You don't have them in there for that wonderful return, because it's not. Bonds are for safety, and safety against default, that's the government part, and volatility, that's the nature of usually shorter maturity portfolios or the G Fund. Thanks for your question, and thanks for keeping time for us. And you can send your questions in, with or without metronomic help, at talkingrealmoney.com on the Contact Us form. You can type them or you can speak them. You can also call us at 855-935-TALK, 855-935-8255. Another question coming.
Hey guys, this is James from Virginia. I had a question on cash balance plans. Right now, me and my wife both max out our 401ks, which I added profit share to recently. We both do our backdoor Roths at the beginning of the year. And with extra cash flow now, we are using our brokerage account. So I was researching other retirement vehicles because right now our brokerage account is our largest one. So I'm trying to find more ways to shove things into retirement, and we don't qualify for HSAs. So cash balance plans came up. I see a lot of pros with it. It lets us put more into that retirement account. It's pre-tax, so there's some upfront tax savings. And then it seems at the end when we retire, we could annuitize it, or what we would probably do is lump sum it into an IRA. I'm just a little questionable on the companies that do it. I feel like they all kind of seem a little bit shady. I don't know if I'm just not finding the right ones. So if you have any suggestions, that would be great. The other thing is that they set the target to be, usually like 4 to 4.5% as far as the investment growth. So I get the reasons for not being overly aggressive, because then you would have to, as the employer, put more into it to make up for down years. But I just really wonder if the juice is worth the squeeze for someone like me, where my risk profile is, much higher than that. And I could just stay in my taxable and invest the way that I want to. The other thing is they don't really seem to share what investments they do. So I doubt it's low cost options. So I'm sure they're making, large commissions on it. But I was wondering if you had, any pros and cons to it, and just you could share your thoughts. I'd appreciate it. Thanks.
I just feel like this is another case of the tax tail wagging the investing dog. These plans, I feel good calling them gimmicky. I really do. They are kind of the worst of both worlds. They're a defined benefit plan, like a pension. And the establishment cost of these things, even the cheapest of them, at least from everything I've read, can be thousands of dollars up front and then a small fortune ongoing. And there are all kinds of potential downsides. In there are audits required. There are reports that must be filed. All of these things are expensive, and then you've got this opacity of the investment portfolio. You're just not going to know what you're making, and I truly do not trust the lack of clarity and transparency around these plans. It makes me worry. So I'm telling you, I can't find anything that would make me want one. I take all my money that I can't put in my tax-advantaged accounts, and it goes in my taxable account in a tax-managed manner. That's the key. And when you get that, you are at the level, the point in your life, if you don't have a fee-only 100% fiduciary advisor, you really should have one. Before you blow money on something that could end up being a nightmare for you, get an opinion from somebody who does this for a living and does it in a way that's required to be in your best interest, because you're probably not going to find that with a lot of these cash balance plan people. And really the main benefit to them is, and I think it's a minor benefit, is if you plan to annuitize, if you plan to take an income stream from them. I think that it is very likely the tax savings will not in any way even begin to approach the potential for return you have on your own, building your own portfolio that's appropriate for your risk tolerance, and apparently you have a high one, and that's well invested in tax-advantaged vehicles. And, for example, ETFs are a somewhat tax-advantaged vehicle. You don't get a deduction, but you certainly get deferral on part of that growth if you don't mess with them. So no. And I'm pretty sure you'll find that most 100% fiduciary advisors are going to agree with me. This is something designed to make somebody other than you money, I believe. But I'm a cynic. 855-935-TALK is a telephone number you need to remember. You can call us and talk with us on Saturdays from 3 p.m. to 5 p.m. Eastern. Or you can send questions in like most of these folks, well, all of these folks have done, at talkingrealmoney.com.
Hello. I have a question, of course. I know it's early. I'm 66 years old, and I've been thinking about how I would like to receive my RMDs in the future when I turn 73. I worked for a university, and I have like a, defined benefit retirement, and also transferred a 401k at the university, and it's with Fidelity. And I was just wondering, when that happens, when I need to take the RMDs, should I take it in a lump sum form before the qualifying year is over, or should I take it monthly or quarterly? Is there a good strategy on that? And also, would Fidelity figure out, the calculations, the dollar amount that's required on my behalf? Just a quick question I've been, thinking about in my head when that time comes. Hopefully, you can answer this question. I'll be deeply grateful. Thank you. Bye-bye.
Thanks for the question. And no, it's not too early. You want to be thinking about this stuff ahead of time, because like I do, that once you get into your 60s, 7 years is like 7 weeks were when we were younger. So it's not going to take very long for 73 to get here. In answer to the question about strategy, I'm a big believer in waiting until the very last minute. Wait until December of the year in which you have to take the withdrawal. Don't wait too late so you don't miss it, but I would get Fidelity to set up a schedule for withdrawals. And yes, they will calculate the amount. You just tell them when you want to receive it, and they'll transfer it from the tax advantaged account, the retirement account, into a money market fund or something else that you designate. So yeah, they can do it. They will do it. And I would do it at the end of the year so that you take advantage of the fact that most years involve profitable returns. Some don't, but most do. And you're playing the odds, and you're getting it without those intermediate taxes. There's a little advantage. It's not huge, but it's a little. Thanks for your question. Let's go to the next one.
Hi, Don and Tom. This is Carl from Jefferson, Maryland. I just turned 60, and I had a question about 401ks. I have been participating in my current employer's 401k for over 20 years. 401k is with Principal Financial. There are 39 funds that the fees range from 1% up to 2.3%. 21 of those funds are at or over 1.5%. The expense to performance ratio has been disappointing, to say the least, over the years. My question is, can I leave the plan before leaving the company and roll it over into something like an IRA? Even losing the employer match, I could have done better somewhere else years ago. Thank you for your time. Love the show, and I especially love all the jocularity.
Well, no jocularity on this response. Just outrage. Outrage. I'm outraged. Wow, I'm outraged. I almost stopped your question in midstream to express the outrage when you told us what your fees were. What is your employer thinking? Is it a big employer? Is it a small employer? I hope if it's a small employer and you have some relationship with the owners, tell them they're doing themselves a disservice with this principal account. Got to be somebody of somebody somewhere. That's my take on this. Really, fees starting at 1 and going up to 2.3. Betcha they're almost all actively managed mutual funds, too. This is the industry, and this is why I despise so much of the industry. They think that it's fair to charge you these kind of fees because they believe they're entitled to a certain profit margin so that they can afford the ridiculous pay they give to themselves and their ilk at your expense. Oh, all right, here's what you got to find out. Ask your employer, do they allow in-service distributions? If they allow in-service, then you could take money, move it out into your own IRA, and continue to possibly participate. Possibly. Well, I'd hate to give up the match, though. I don't know what the match is. You didn't give me specifics, but I just hate giving up free money. My first course of action would be to get together a group of like-minded employees and, even play them this. I guarantee you Tom totally agrees with me, and almost any other fiduciary advisor in America is going to totally agree with me that this is outrageous and it is not in the best interest of the participants in the plan, and therefore the trustees of the plan, whoever the people are who are giving the orders, they have liability if they're not acting in the participants' best interests. And I could make a reasonable case, I think, not an attorney, that this is not in your best interest. It may be a pretty common product, but a best interest standard, don't see that. Do not see that. There's also now, probably not in the current political situation. I was going to say that you might go to the Department of Labor, but probably no one there anymore. It's just a phone will ring for a while. See, I'm speechless. I'm so outraged. I'd try something. I really would. I would call Vanguard and say, hey, how can you help me? Or Schwab or someone, how can you help me find a way or Fidelity, find a way to help my employer get out of this plan and put us in something that's better for us? Wow. Keep me posted, please. But ask if you can do an in-service distribution. All right. It's the last one of the day. Here it comes. This was called in to talkingrealmoney.com. Hit the contact us button. But remember, if you want to talk with us in person, you can call every Saturday, 3 to 5 p.m. Eastern Time at 855-935-8255. Here we go.
Hey, Don. This is Jeff in South Carolina. I've got to ask. I think I know your answer, but they have to exist for a reason, right? Is there any situation where an annuity is the right thing to have? Thanks.
What a wonderful way to end the podcast. The annuity question. Of course, there are use cases for annuities. They've existed for a long time for one reasonably good reason. Reasonably good reason? Is that redundantly redundant? That is, they make a nice vehicle for someone who wants a high degree of certainty in their income stream in retirement. And this is the only use case that we advocate at all. And not in many cases, but in some cases. It makes sense to have an immediate annuity when you want reasonable certainty. Not 100% because nothing is 100%, but 99% certainty that you're going to get a monthly check for the rest of your life, and you're willing to give up your money to get that. You're willing to hand over your wealth to someone else for the promise of an income for your life. They are making a bet on the other side. They are betting that you die sooner than you think you will. And therefore, they get to make a lot of money off your money and then keep whatever's left. Is there a use case for variable annuities? For the client, no. For the people selling them, yeah, sure, yeah. Oh, yeah. They're designed to be a sold product, because it's a way for them to give you the pitch like, well, you can get tax-deferred growth on your money as opposed to putting it in mutual funds. You can put it in mutual funds in this annuity wrapper and get tax-deferred growth, but they don't mention that you're going to pay extra in fees that'll usually eat up that tax benefit. And then when you pay taxes on the money comes out of a variable annuity, it's not taxed at capital gains rates like your mutual funds might be. It will be taxed at your ordinary income rate. Is there a big benefit? Yeah, to the insurance company. Indexed annuities, same story. They just create complicated things to pull the wool over the customer's eyes. That is the reason for their existence. Is it a good reason? Well, for the companies. Is it a good reason for you? No. That's why we just say, in most cases, if it has annuity in the name, you can skip it. You can just ignore it. If it has insurance in the name or an insurance company's name on the product, skip it. Because most of the time, it's just not in your best interests. It's in their best interests. Oh, that was a nice episode. I had fun. Thank you all for being a part of it. I really appreciate you. And remember, again, call us on Saturdays, 855-935-TALK. That's noon to 2 Pacific time, 3 to 5 Eastern. And you can listen to us on Northwest News Radio, too, on the internet. So you don't even have to be in Seattle. And please tell a friend or two, or dozens, if you get the opportunity, because really, truly, truly, absolutely, the more the merrier. If you have like a blog or something, blog about us. I'll even, you can talk. If you want to interview me, you got a blog, you want to interview me, call me. I'll do an interview. You got a podcast, I'll do an interview. We just want to get the word out about this show and continue to build its audience for the years that Tom and I have left to do it, which we hope is many. Thank you all for being there. Take great, great care of yourselves. And remember, almost every day, we're going to be here talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.